Volume in trading is the number of coins, tokens, or assets traded in any given period. It is displayed on price charts like this. Simply put, trading volume is the combination of the total number of tokens, coins, or assets traded during any given period. Higher trading volume equals higher liquidity in the market. Lower trading volume equals lower liquidity. When we're trading, we want to see high liquidity, more people involved in the trade. So as an example, if I entered a trade and there was low liquidity, then the price action is going to be quite muted. So in terms of volume, we want to be trading with tokens and coins which have high liquidity. High liquidity equals better trading because there's more people involved in that particular token or security. Low trading volume would mean that there's not many people involved and the price action is going to be quite muted. So wherever we're trading, we want to see high liquidity, high trading volume. This is a great little chart to help you use volume to improve the success rate of your trades. When the price action is increasing and the volume is increasing, that means that the trend is going to continue. So if you are in a long trade and the price action is continuing to go up, as is the volume, that shows you that there's probably higher prices ahead and the trend will continue. If you see price action continuing to increase but the volume starting to decrease, that would be an indication that you need to exit your trade, exit your long position, as it might suggest that the price action is going to reverse and there will be a trend change. If you see the price action declining along with the volume declining, that is another example of a trend reversal. If the price action is in a downtrend and the volume is increasing in that downtrend, that again is confirmation that the trend is going to continue because people are selling in increasing amounts. So just being aware of these 4 different combinations can help you spot changes in the price action and trends, which can help you know when to enter a trade or when to exit a trade. So what does this look like in the real world? This is Bitcoin 2-hour chart. If we zoom in to some price action we had back in August, the price action was very static. It wasn't really moving at all. Very low liquidity. You can see the volume here was quite low. We had this potential move to break out above this resistance line, but as a trader, there was insufficient volume to make me believe the price action was going to go up any higher. So it was what you might call a bull trap. So the price action comes up and then quickly comes back down. The clue that it was going to do that was the fact that the volume hardly increased from how it had been the last few days where the price action was static. However, we move on a few more days and the price action has another attempt to break this resistance line, but this time the volume is significantly greater, which as a trader tells me that the price action has probably got legs and will continue beyond this resistance line and maybe up to the next level, which it did, which allows me to comfortably trade this by seeing that other people in the market have the same idea. So the lack of volume here would have stopped me buying the breakout. The fact that there is significant volume here would have given me the confidence to buy the breakout of this particular level. Now the price action of course rolled over here, but that's an example of how you can use volume to trade. Here is another example of how you can use volume in your trading strategy. There is another way to use volume to trade in this market is by using an indicator called the fixed range volume profile. So this is a token called OMG, and I'm just going to add the fixed range volume profile to this chart. Now what it will show me is, it will show me where the liquidity lies in the market, where there's the most volume occurring. And it's between this range here, these 2 points here. Beyond this point here, we have a low liquidity zone and we have a low liquidity zone here. Typically, the price action will reverse at the extremes of the fixed range volume profile. So as you can see here, despite the price action coming above this trend line, as we reach the low volume node and an area of low liquidity, the price action reverses because that's where the most sellers are. Likewise, you can see here at the opposite end, where there is again a low liquidity, low volume node, the price action typically reverses, and we can see we're at that point here. This is another tool you can use to double check and confirm where the price action is likely to reverse, because looking at trend lines alone can sometimes be insufficient. However, trend lines do typically line up with the key area and points of the fixed range volume profile, but as illustrated here, sometimes they don't. And you can therefore use the fixed range volume profile to double check where a potential reversal will occur. Traders are going to want to trade within high volume, high liquidity areas because that's where you're going to get the most movement. So using the fixed range volume profile can help you ascertain where the price action is going to reverse and potentially where the price action is going to stay or gravitates towards. Using the fixed range volume profile like this would be in addition to using volume in the traditional sense to see when the price action is going to move significantly or not. So you've got the traditional volume here on your chart, and then you can add the fixed range volume profile to have a look at how that impacts the range of the price action. In the next one,